Welcome back, friends. Those who have been watching the global stock markets over the last fortnight may have noticed that there has been a little mellowing of the market momentum and sentiment. Now, this is all on the back of a good last few months where the markets have really gone across the world to touch all-time highs in many indices. And suddenly you find that there is some sort of a withdrawal of momentum that is taking place. And it is beginning to startle people where people were imagining that there is going to be a Federal Reserve rate cut coming in shortly, where just we imagine that inflation is about to be controlled well and the economies across the world are doing well and roaring higher, leading to a Goldilocks situation. Whether the sudden loss of momentum in the world stock markets is an indication of a routine shakeout in stocks or signs of some tougher times ahead. Friends, that's the question that is uppermost in the minds of investors as we begin this new week starting August 14, 2023 across the world. Are we seeing some sort of a consolidation, or is it much more? All this comes on the back of a 5-month rally. And just when the technicals began to look stretched, when the sentiment started beginning to get frothy, and we saw some negative seasonality starting to creep into the picture. On the other hand, we also saw bears capitulating, economy looking very strong. So, are all these indicators the makings of an ironic top in the market, or we are going much beyond that? Friends, we see companies in the S&P 500, that's a major global index, decelerating on revenue growth and beat on margins. We are seeing a very, very unique phenomenon taking place, that the companies which are missing the numbers are doing better than the companies which are meeting the expectations. So if you are missing the numbers, you're doing better than those then actually those who are beating the expectations. This is something very unique. For example, of the 51% companies which reported earnings in the S&P 500, we found that 81% were beating the expectations, and which was the highest in more than 7 preceding quarters. 61% beating on revenues. Yet you found that the companies which were beating the earnings expectations were down 0.7% as compared to the 5-year average of +1. That shows something is changing, and changing fast. Companies such as Palo Alto, Nvidia, these are among the worst performing tech stocks of late. These have been the high flyers. Are we in a situation where artificial intelligence and artificial intelligence induced stocks, friends, has created a bubble that these stocks now are beginning to lose their shine? Or is this just some minor consolidation that's taking place and some amount of profit booking when the markets had run quite far ahead? Let's look at the 10-year yield. Gone below 4%. But since the Fitch downgrade, and then thereafter we just now saw the Moody's downgrade of 10 regional banks in the United States, we have seen the 10-year yields go past 4.08%. And in fact, they are pretty much close to the 2022 highs. To be precise, the 10-year yields are now just 14 basis points lower than the Thanksgiving of 2022 highs. Let's look at another picture, friends. that every treasury that is 3 years or less is now down. Every treasury bond 5 years or up or more is now up. The spread between the 10-year and the 2-year treasuries is equivalent to minus 0.82. This shows the least inverted curve since the failure of the Silicon Valley Bank in March of 2023. The markets, which had appeared to have reached a sweet spot with inflation coming down, growth being robust, and the Federal Reserve seeing a very deflationary or disinflationary economy, which is yet very strong, is now going to be able to have to confront a situation where the treasury yields are, however, kicking high. There is over $1 trillion of treasuries which are about to hit the market shortly. We have Japan monetary authorities going into rejig of their bonds. And we have China story, the Chinese economy coming out of the shutdown but not doing so well. All these are the makings of an unholy cocktail, and they are beginning to show signs of a wearing down of the market. Friends, it is never easy to justify such a fading. I mean, you had a situation where the earnings decline was expected to be there, and right now the writing is on the wall. Look at the results of Apple. Here we are seeing a decline in the iPhone sales, struggling to meet the expectations within the US. Now we have companies like Apple looking at markets overseas like India, where they're expanding very, very fast. All these are showing signs of a maturing market for iPhones. Whereas the overall scenario remains robust, yet you've seen several quarters of declining sales for iPhone. And naturally iPhone is all, and therefore you have Apple also feeling the heat. China coming out of economic slowdown, but look at your economic data, far below the expectations. So the heat is turning on, friends, and turning really fast. And momentum is beginning to change, and do not be surprised to see a major drawdown or a pullback in stocks taking place. To get to know more, please do join our Prime or Prime Plus channels. For the US markets, for the Indian markets, you may join Premium or Premium Plus. Number to get in touch, 982-086-1044. Alternatively, you can also email us at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Happy investing and have a great investing week ahead. Take care. Bye-bye.